Good afternoon, everyone. Welcome to today's webinar. The webinar is the role of DFIs and financial institutions in the post-COVID-19 recovery. This is our 10th and final webinar on our COVID-19 impact on African real estate series. I would like to thank our headline sponsors, Standard Bank, and our series sponsor, Nedbank, for their continued support and for allowing us to make this series possible. Last week, we focused on the impact of the pandemic on the West and Southern African regions, and today we'll be focusing on how DFIs and financial institutions are managing their commitments and investments, as well as what their role will be in the post-COVID-19 recovery. We're very fortunate to have an excellent panel with us here today with representation from across the globe, including speakers from the UK, the USA, South Africa, and Seychelles. I would now like to introduce them. Moderating and setting the scene for the discussion is Phil Goodwin, Executive Chairman, Fusion Group. And our panelists for today, Gerard Zilli, Head of Property Finance Africa, Nedbank South Africa. John Efte, Regional Coverage Executive, Trade and Development Bank. Deborah Erb, Managing Director, Real Estate Project Finance, Office of Development Credit, US International Development Finance Corporation, DFC. And Gozi Chigbui, Director, Africa Funds and Capital Partnerships, CDC Group, UK. Thank you all for giving of your time today and for providing your insights. For our audience, as always, we encourage you to ask questions to the panelists via the chat function, and we'll also do our best to answer as many of these during the course of the session. We'll also be conducting polls during the webinar, so please make sure to contribute to these when they come up. I'd now like to hand over to Phil, who will set the scene and dive into the panel discussion. And I'd also like to ask the panelists to all please switch on your cameras and audio.
Hello. Now we're all here. Hello, and thank you for that introduction, and thank you to everybody who's digging into their day to tune in. We're hoping for a very interesting discussion. I would encourage you to ask questions because the participation of the audience will make it a livelier occasion. So I guess we're all taking a deep breath and saying this crisis will be over at some point. It isn't over for many people. And of course, the public health crisis is one thing, and then the ensuing financial crisis is quite another. But we will start to come out of this crisis at some point. And what we want today is a very forward-looking discussion. So we want to look at, I'm going to be asking the panelists what's changed for them, what's changed in their thinking, and what might change in the future. And I'm going to be asking them what contribution they feel their institution is going to make. I think we all have to accept some of this is very much work in progress because the issues are still with us. The thinking is often at an early stage. But the panelists have agreed to give us some idea of what they're thinking. And where their thoughts are heading. So I'm going to jump right in, and I'm going to ask, what have we learnt from the crisis in the context of African real estate? What have we learnt? Have we learnt anything about African infrastructure and what the African infrastructure needs actually are? Have we learned anything about the kind of property we've been developing? Have we learned anything about the retail capacity that's really required in this market, the office capacity, the residential capacity? And I'm going to put that question first to John, if he can pick that one up and lead us off. So what have we learned from this crisis, John?
Yeah, thank you, Phil. I think one of the most important lessons learned from COVID-19 is that obviously what have been done in the past in terms of how we chose to finance businesses cannot continue in the future. I mean, obviously, we need to have a fairly balanced portfolio. I think some of us have found ourselves probably fairly overexposed to certain sectors. We haven't necessarily configured or helped the businesses to configure themselves to survive a crisis. In some cases, I think banks had at their disposal the ability to provide some disaster proofing, for want of a better word, in how they structured the facilities. For example, you could basically consider debt service reserve account. And the question is always, how long do you provide that for? Do you provide it for 3 months, 6 months, or entire year? Normally, in financial security context, we would say everybody needs to keep aside 6 months worth of income for them to be financially secure. But when it comes to maybe analyzing businesses, we don't always go to that extent to make sure that if there is a crisis like there is now, we are able to ensure that the business can at least pay us back during that period. We've also learned that the types of developments, I think in real estate, one of the areas that I can talk about is tourism, that we probably need different types of hotels. We have been thinking about hotels where tourists will come in and interact with the community. And now we've seen that there is also a need for the type of facilities where they can come in, a plane load at a time, and be in a fairly confined area where they don't necessarily need to interact with the local community. So I think these are some of the things that I see, amongst others, of course, that we've learned and we probably do differently in the future.
Yeah, interesting. And so points there about the robustness of financial structures. Certainly, something I've learned from this crisis is, we need to look at the sensitivities we run on things. The kind of sensitivities we got into the habit of running have not included examples where there is no revenue for 6 months, for example. And also about the type of development, particularly in hospitality. Deborah, would you like to pick up anything on that? You see things from a worldwide perspective. I know your brief covers the globe basically. So what do you see in Africa, and how would you compare that with other places?
Well, it's from where I sit, we don't have a huge portfolio in sub-Saharan Africa. So what I would say is, I hesitate to say that we're going to go back and rethink our entire risk assessment process, and because you can stress test any project out of existence with no problem at all. I think we have to make some reasonable assumptions about the near term and how our existing projects are going to perform in the near term, and how we can adjust our assumptions. But beyond, say, 6 months, I honestly, if in Africa, if I were to require 12 months cash reserves for operating costs, I don't think I would fund a single project. I don't think the equity capital is out there to support those types of terms. So my thinking is that we're, aside from doing what we can to help make our existing projects sustainable through the next 6 months, I think what we need to do is be more conservative about the sizing of projects and our assumptions on absorption rates, and thinking in terms of working off of relatively low cash flow assumptions. But in terms of the loan terms themselves, I think it would be very difficult to find financeable projects given the lack of equity in the region traditionally. I think it would be very difficult for us to do anything if we tightened up our terms dramatically.
Mm-hmm. What about you, Gozi? Do you take the same view? I mean, and do you take the view that Deborah is expressing there? I mean, is this a black swan event? You know, a once in a generation event, and therefore we don't need to plan for this again. We don't need to be robust to this kind of event because it's not going to happen again for 100 years. Do you take that view or any different view?
So thanks, Phil. I think as we think about the current macro situation in key markets in Africa, right? On one hand, you've got COVID, but you've also got other macro issues. For example, what's going to be commodity pricing, crude oil, etc., in key markets like Nigeria, for example. So I guess we are seeing more negative macro incidents occurring more frequently. The time gap between recessions is shortening, and recessions are staying for longer. So I guess the question is whether this is a black swan event. I think it's I do expect that we will see more of this, maybe not at this same scale. And so there are lots of questions for the real estate sector more generally. How do we, for example, get the balance right between domestic capital mobilization and international investor? How do we think about the structuring of debt and building in more resilience, like you said, in the modeling, but also in our cash flows and reserves? But also, as we think about the subsectors in real estate that have been perhaps a bit neglected, if you think about offices and retail, where lots of capital has traditionally gone, can real estate and private capital start to play a more active role in other subsectors of real estate, whether it's warehousing or healthcare facilities, etc.? So I do think we might not see the same scale of this black swan event, but there will be smaller swans, in a sense, repeatedly occurring over the next 10, 20 years.
Mm. Yeah, we're never short of crises in African markets. That's what I always think. There's always something happening in a way that makes us better at dealing with them. More robust to them. Gerhard, do you have a view? Nedbank's been a big investor in retail, for example. Is that do you wish you hadn't done that now, or do you think that there's the appropriate level of provision there, or how is your thinking changing?
Look, I think probably not something that all of us learned. I think we all just confirmed again that whatever you put into an Excel spreadsheet is definitely not going to be the way that the project runs. And the feasibilities that you've modeled never sort of follow what you try to model in your Excel spreadsheet. I'm of the view that you can't model something like COVID-19. And I do think if you try to model it, you're going to be building in such low probabilities that to leave it out would probably put you back into the same position. I think what we have learned is how important subsector diversification is, how important country diversification is, and also how important it is to have the right capital structure. And I think John, Gozi, and Deborah maybe touched on that a little bit as well. It's not always the cheapest capital structure, but the most appropriate capital structure. I think that's important for these projects. I think that's it. I feel. I mean, you mentioned retail and all of that. If we're just talking, obviously, Nedbank is the largest commercial property financier in South Africa. Over the last while, we've also expanded a little bit into Africa. And I think my response to your question is, again, one needs to be balanced. And I think we're going to talk about subsectors a little bit later on. And again, I think it's important to reflect on, as COVID happened, how did that impact on different subsectors? And what we're talking about today, as COVID unwinds, how will the different subsectors react to that again? And I think it's interesting to note how these different subsectors behaved. And again, just highlighting the importance of diversification.
Yes. Yeah, so you mentioned geography there. I mean, does this mean that your institutions will be going for greater geographical diversification? So rather than concentrating on particular areas, will you look to spread it? How has it affected your view on that? Gozi, could you give us a view on that?
Okay, so I mean, at CDC, we look across both Africa and South Asia. We do try to be geographically diverse. I think one of the unique aspects of CDC's strategy is we try to go into countries where perhaps that the struggle to attract and retain international capital. So I do think it's not going to change markedly. We're invested in countries like Sierra Leone, but also in countries like South Africa and Nigeria, and that will continue in the long term. So I don't expect a massive change to our view on countries at CDC.
Yeah. Deborah, can we expect more from DFC in Africa in the future?
Well, DFC has a new initiative. OPIC, it was Power Africa. Under the DFC, it's Connect Africa. So I would say from a political standpoint, a foreign policy standpoint, there's still a very strong commitment to sub-Saharan Africa. And in the real estate perspective, what I've observed is that tends to relate primarily to things like warehouses and distribution centers, cold storage, food security types of facilities, major infrastructure, of course, transportation infrastructure and other core infrastructure. But on the real estate side, I say it's mainly distribution. Housing, I would like to say, is an infrastructure sector, but we'll talk about that a little bit later. Geographically, we've never had a particular focus in any one region of sub-Saharan Africa. It tends to ebb and flow depending on where investors are going, because we don't drive the bus. You know, we go where investors are placing equity capital. So a lot of what we're able to do going forward is going to be dependent upon where private sector investment goes.
Yeah. John, what Deborah mentioned infrastructure there and the distribution infrastructure, logistics. Is this going to be a big area of opportunity going forward? What have we learned about the logistics infrastructure that's in place in Africa and what the opportunities are? John, you need to go off mute.
Yeah, apologies. Yes, I mean, obviously, as a trade and development bank member owned initially, we've actually historically focused on a lot of infrastructure development, roads, warehouses, ports, and other infrastructure, as well as the other type of funding that facilitates trade. So those areas that Deborah talked about, this is something that we will definitely continue. And we have seen recently a very big logistics challenge between, I mean, obviously, when there are no flights between countries. I understand also that most goods, especially perishables, are actually transported in the body of passenger planes. So when those passenger planes are not flying, we have a very big problem, which is why some of the airlines have now focused on cargo. If you look at Ethiopian Airlines, for example, they recently had to convert a lot of their passenger aircraft into cargo planes, and they are powering African cargo transport. So I think this is something that we need to look at a lot more closely. Look at the actual infrastructure to make sure that in the event, I mean, we did agree earlier that perhaps we should not see that type of event to that magnitude happening again in the future. But I agree with Cozy that obviously you will see many smaller events, but in the short term, they could have a very big impact. So we have to be able to see whether our activities, funding areas are enabling our countries, member states especially, to be able to distribute, to be able to move goods in and out of their respective countries.
Yeah, I mean there must be some opportunities in the logistics area. Is that something you're looking at, Gozi?
Yes, so CDC has invested directly in logistics, but also through funds, we have quite a big exposure to the space, especially in Eastern Africa. I think it's as we think about our priorities in real estate, warehousing, data centers, logistics, cold chain storage, in addition to healthcare and education facilities, are the priority for us, and housing. But then traditionally, I think when the asset class really took off in sub-Saharan Africa, obviously retail and office was the initial focus for many investors. But I do see others also moving in the same direction as CDC now.
Yeah. Let's talk a little bit about the office market. I mean, the office markets that I know best are in East Africa, and they suffer from oversupply. I mean, there is significant oversupply, or there was significant oversupply before this crisis hit. Do you think that this crisis is going to exacerbate that problem, make it worse? And if so, how can the market, how can the DFIs help the market recover? And how should the banks behave in this context? Let's start with a banking view from Gerhard.
Yes, I agree. I think certainly it's no secret that in East Africa, and we talk East Africa, mainly Kenya, and then also specifically Nairobi, especially in the uphill area, there's been a massive oversupply for a very long time of office space. And I think probably the most difficult subsector to gauge at this point is offices post-COVID. I think to talk about retail or hospitality or industrial is probably the easiest of the lot compared to offices. So I think it will be very, very difficult to try and speculate around what's going to be happening to office space. I think investors are going to be very, very careful to develop new office space until new models are being developed in respect of how office space will actually be used going forward, and to what extent people will spend time at office versus time at home. How will that impact on traveling and saving hopefully time by working instead of sitting in the traffic? One view, of course, is, and we know there's a massive demand of residential accommodation across the continent, and then one view would be to how one would actually start converting some office space into residential space. That might not be appetizing for a lot of investors or holders of office space at this point in time, but I do think there's the opportunities for banks, DFIs, and also governments to work together to try and build a model that will actually try and use some of this office space, and if it's not for offices, maybe for residential space.
Yeah, I mean, repurposing is a very interesting trend, isn't it? It's an interesting thought. Do you have any thoughts on that, Deborah?
Yeah, I 100% agree. My view of this in retail and office sector, housing, just in general, urban real estate environments, I think the trend has been towards more flex space, more mixed use, integrated income levels and types of properties in how should we say, well-planned urban communities, center city types of communities, walkable communities. There's been a trend in that direction, and I think that, frankly, I think COVID is going to accelerate that trend. So we've looked at a few projects like that in Latin America, which are more around urban redevelopment, revitalization types of programs. But in this case, talking about repositioning existing properties that are single purpose into something that fits that, multi-use environment would be very interesting. I don't know how financeable it is from a credit perspective, but I can definitely see from a market perspective that it's a reasonable, it's certainly something that we would look at. And the question would be, could you find an experienced, reputable firm that could come in and maybe has done that in other parts of the world, that could come in and do a test case in Nairobi, for example.
And do some repurposing, yeah. I mean, you mentioned, Gerhard mentioned Upper Hill, Nairobi, and it would be quite amusing to see that many of the offices there started off as residential blocks, then they were converted to offices, and it would be quite amusing to see them being converted back to residential. Is this practical for DFIs? Is this something that DFIs can help with? Because there's always been this reluctance with DFIs to make secondary purchases to play that role in the market. Recently I've thought myself, no, this is what this market needs. Is it actually needs somebody to be the purchaser of distressed assets, reposition them, repurpose them, whatever. Is that something that you guys can contemplate? Can I ask Gozi to address that? Is that something you could do?
No, I mean, you're right. This is a really hot topical issue, right now. I think if I think about the value chain or the construction process, it still feels like the pre-development and the development stage is where there's the greatest need for patient long-term capital. And it does feel like DFIs are perhaps best suited still towards directing the bulk of their capital to solving that gap. I think on the secondary side, while there might be a role for DFIs and similar institutions to play, I do think strong capital markets participation should be the right solution, the right primary solution here. Whether it's around buying built properties and repurposing, or thinking about sale and leasebacks, where you have strong, credible corporate anchor tenants with steady cash flows that can then, whether it's a REIT or similar type products, I do think there's definitely a role for secondary buyers, particularly through the capital markets.
Yeah. John, do you see this as something happening? Something that will happen?
Well, I guess it would be something that we would consider in the long run. I think one of the key things that we look at normally when we finance real estate type development, we look at alternative use. So it is always in the equation that we consider what else. I mean, be it a residential, be it a hotel, or be it a commercial property development, to consider what alternative uses could be put to in the event that it doesn't actually perform as well as anticipated in its originally intended purpose. So we do tend to look at this, but when it comes to the issue of financing the acquisition for a conversion purpose, I think one of the key factors that ourselves, DDB, and many of the DFIs that I know is looking at impact. So what would actually make the biggest impact in the respective economies in terms of a conversion would be what we would probably have appetite for, provided the business case stacks up.
Yeah. I mean, Gerhard, from a banking perspective, I'd be interested to hear your thoughts. So there are plenty of examples in Nairobi, for example, where what's needed from the banks is a more imaginative array of solutions to defaulting clients. There are all these empty office buildings, but basically the banking community's response is to try to get everybody to pay, and to try to auction things if they don't. It's kind of not going to work. because there just isn't the demand for those offices. Do you see banks coming up with a more imaginative range of solutions to that kind of situation? And I know there are regulatory issues. There are all sorts of issues involved, and not least that it often costs quite a lot to do these repurposings, and it has to come from somewhere. Well, do you think it's something that will develop post COVID?
So I wanted to, before I answer your question, I wanted to just comment on some of the previous thoughts around the repurposing that was shared by some of the other panel members. And I think the only way that repurposing will work is if it's driven by local authorities, where they actually redesigning the urban planning frameworks, and incentivizing the change to those new frameworks properly. Otherwise, it will never work. It's hard for somebody that's invested in an office building to say, office building, I can model a certain return. For me to incur the cost to convert it to residential is X, and my yield is probably not attractive. Very, very difficult to make that move. Unfortunately, over quite a number of years, there has been these massive vacancies in the office market in Nairobi. And you mentioned banks and how banks can play a role. It's very, very difficult for banks to come up with solutions where there is clearly no market take-up of product. So there's no ways to restructure the transactions to work. Again, I do think banks can play a role in repurposing, but that cannot be driven by banks. I think banks can act as financiers, but that drive needs to start with, like I mentioned, local authorities with proper incentives, and then also investors and developers that can manage the transition and also the management of the new asset class, or subsector rather.
Yes. So some kind of public initiative, some government authority initiative would be helpful in this, wouldn't it? Okay, that's interesting. Now, we've had a number of mentions of housing. What part does housing play in your thoughts going forward? Obviously, the obvious points being, I think it has exposed, if it needed exposing, but it has been exposed, how can you control a public health crisis if you don't have basic good housing? How can you achieve distancing? How can you do sanitation if you've got large urban populations living in slums? What part does housing play in your thinking going forward? Maybe we should start with Deborah.
Housing is the whole issue of the juxtaposition of housing and public health those of us in the sector have always realized that proper housing has a lot to do with proper education and proper health care, and just general public safety, security, etc. But I think this whole crisis has brought that to the fore very clearly. So from our perspective, we're going to continue to push for for example, requiring that our projects use the EDGE program, for example, to be developed in the most green and energy efficient, resource efficient way, but also focusing on overall community services. We'll talk about healthcare facility a little bit later, but these communities that we're financing have a need for decentralized healthcare clinics, for just even small clinics or well care for mother and children. Those are the types of things that I think we should insist on including in any future housing projects. And I think that that's an area that, from our perspective, we would be able to mobilize maybe some grant funding or other support that wouldn't normally be included in project cost for a typical real estate project. But recognizing that this is something that's necessary for new housing developments or even redevelopment if it comes to that. And I think we would find the resources to support that.
Yeah, absolutely. Including medical facilities in major residential developments is something. Some people do it, but it would be nice to see that become universal, wouldn't it? Because it's certainly needed. What about affordable housing? What is? I'd be interested in your view. What is affordable housing? What does it have to be affordable? And what's the basic minimum standard that should be that we should be financing? Do you have a view on that, Gozi?
Yeah, I think the word affordable is a pretty emotive one in the DFI world, and how you define that from city to city is a big question. But I guess just before I touch on that, maybe I'll take a step back to what Deborah was mentioned. I think for us, housing is the key priority, and the goal is to build sustainable communities. So housing and urban planning is right there at the top of our priority list. And linked to that, and I guess linked to the entire sector, is how we think about climate resilience. So Deborah mentioned EDGE. I think EDGE is key. It's key for us in all the projects we're going to, either directly or through funds. But linked to that is also how we think about the design of the housing, right? Whether are we using the right energy and water efficiency measures, again, to bring down the cost of the building, but also the general cost of running the house and our carbon footprint. But also thinking about the construction materials. Can we do low carbon? Again, all of these will help to bring down the costs of the building, to make it a bit more affordable, while also helping us implement our climate goals. So I'll say maybe I'll stop there by saying housing is definitely a priority for us. We recognize that affordable varies from location to location. There's no set standard, but we are trying to direct as much of our capital as we can into that space.
Hey, why don't you guys cooperate and come up with a definition of what's affordable? Come up with that would be something.
We talk about this.
You guys should set an industry standard. Yeah, Deborah.
We talk about it all the time among ourselves. In fact, I had a call not too long ago with CDC on this very subject. I will say that for us, typically, I start at somewhere in the US dollars, say around 30 to 50,000 US dollars. So in Nairobi, for example, I would say 3 million shillings would be the perfect price range for us. If we can do it, if we could finance houses for less, that would be great. And I don't have my Naira numbers at the front of my mind, but just to give you an idea, okay, so say 3 million, 2 or 3 million shillings in Kenya. But we're financing apartments in Baghdad, in the green zone in Baghdad, that are selling for 150,000 US. But that's affordable in a major city in a upper middle income country. So it's correct. It's very dependent on the location. But I will say that the other thing we do is we look at who's the target market, what's the demographic. So we're thinking workforce housing, right? We're thinking teachers and entry-level office workers, self-employed, even self-employed taxi drivers, or even market ladies or small bodega owners. Those are the types of people that we want to support with housing programs.
Yeah, John.
I think you asked for a definition of affordable houses. Affordable housing actually should be houses that can be afforded buy one. Now, the challenge is if you go back to the original point that Deborah made about what housing development should basically constituent elements of housing development, which should include the health centers. If they are big enough, you should even have community-based schools. You should have health, fitness facilities, shopping, etc. So I believe you're looking at a completely self-contained community that can, of course, survive challenges like COVID-19 in the future as well. Now, when you get to that level to make them affordable to everyone, it probably means that they cannot be financed on a pure project finance basis because the project cannot pay back itself. So that means government has got to get involved and have got to subsidize the development. So that's where probably DFI can come in and look at financing those governments themselves on sovereign level as opposed to project finance level. But I think it's a very big challenge because I'm not really seeing within our portfolio many projects of that description coming through. What we tend to see is high-end luxury developments. I mean, they make good project finance sense. Sometimes you get mid-range type developments as well that also stack up. But at the bottom end, I think this is where there probably needs to be a lot more support and focus. But the initiatives have got to come from the respective governments.
Yeah, and I think I would add that two other considerations here would be, one is how do you encourage, like you mentioned, how do you encourage developers to actually prioritize low returns housing versus their own the opportunity cost, which could be high-end housing or commercial property. And then on the tenant side, how do you then support them on the financing to acquire these properties? How do you build in rent-to-buy schemes, for example, or long leases to enable them take possession of these properties? And then finally, I think, look, when we talk about affordable housing, to show how dynamic affordability can be, I mean, every time you have a step change in currency in Nigeria, which, for example, is at this rate, might be every 3 years, what does that mean for affordability if you have to import steel every time you build? And so I think there are a number of considerations here, from the market to the end user financing, that also need to come into play alongside government to make this really work.
To make it work, yeah, absolutely. And we need to think about what is the total cost of occupancy for people in these developments, because there's been too many developments where the units themselves are priced at the affordable level, but the development is so far away from anywhere that anybody wants to be and has no local amenities. We've talked about medical and school, has no access to anything. So the cost of occupancy, and I guess we'd say post-COVID, the risk of occupancy as well is high. We need to think about all those things. Something you touched on there, Gozi, local financing. Have you guys been thinking about how to mobilize domestic financing for some of these projects? And I guess residential is an area where that might at least be possible. But do you have any thoughts on domestic fundraising? John, do you have any thoughts on that?
Not a lot, I think. But the way that we like to operate normally on any projects is basically we like to work in partnership with the local banks, because we are not there to take away the lunch, so to speak, which means that what we do is we talk to them, we find out what their priorities are, and we tend to come in to support them, especially in those difficult markets. Now, I have to say that in all fairness, most of our markets are very difficult, where foreign currency is a very big challenge. So that's where we come in. As a dollar funding bank, we come in, we normally finance the foreign exchange component of the project, and the local bank comes in with a local component. So we already try to mobilize as much that local funding where it is available. But I think the other aspect of channeling local funding is not in the direct funding itself, but in the raising of financing to support our own financing. What we try to do basically is we recognize that in those countries, there is quite a lot of foreign currency which is available, which is normally placed in financial institutions in Europe or the US. And of course, DFIs, generally speaking, they are not deposit takers. So if we want to finance anything, we have to go into the capital markets and then borrow back the same funds that citizens in our member countries or institutions in those countries have placed with those international banks. Of course, we borrow at the premium. So financing of projects in our countries become more expensive than it needs to be. So one of the initiatives that we're looking at is to get these funds to come directly to us. Of course, they don't have to place it with everyone, but there are a number of A-rated, investment grade rated financial DFIs like ourselves, which basically constitute fairly safe investments. So to a certain extent, yes, we can mobilize this part of this capital, but it's a relatively small drop in the ocean at this point in time. So I'd like to see that improve in the future.
Now, you mentioned REITs there. Is REITs a promising area for this? We certainly know at Fusion, we know from our own experience that to get a REIT done, you need a really solid core investor. Maybe that's something that a role that you guys could take on. Gozi, do you have a view on REITs and domestic fundraising more generally? You need to put your mic on.
Apologies. Okay, so I think you're right. I think there's definitely a role for REITs here. I think as we think about the sources of capital for REITs, right? On one hand, you've got retail investors, but the larger group here would be the pension funds and insurance firms and the diaspora. And the question is, how do we then create the right sort of vehicles or the right sort of pipes to enable pension funds and the diaspora provide the capital for either through REITs or similar structures? So there's definitely a role for DFIs to play, but I do think the DFI struggle is, between putting our capital towards primary greenfield development projects versus secondary. And I think while we can play an enabling role to enable the creation of these products, I think on balance, there will always be a bias in terms of DFI money towards the development stage, which is perhaps a bit more challenging from a fundraising perspective.
So, Deborah, do you see that, Deborah? That will always be the emphasis: greenfield projects.
Well, the development impact is easier to measure for a greenfield because you're talking, all the inputs to get a project off the ground are there. However, there is an aspect of financial sector deepening, and overall development of local funding sources, which has tremendous impact. We're looking at using our guarantee authority to support capital markets transactions in mortgages. We're struggling with the foreign exchange risk issues, but fundamentally, we do have the ability to wrap local securities and sell them to U.S. trust and access much deeper U.S. capital markets for mortgages in particular. For project finance or operating properties in the real estate space, that may be a little tougher. You're right. That's probably a tougher sell for us. Housing and mortgages, which is definitely focused on individuals, consumers, wealth building, all the things that are appealing from our impact standpoint, those are much more easily done. That said, though, if you're talking about, water and sanitation projects, which would be tied to, say, master planned real estate development, I think that that's an area where we might be able to look at using our guarantee for municipal bonds I think REITs are a challenge for us. I agree. I don't know that I see a way for us in that space, but I think there are other peripheral areas where we might be able to support PPP type arrangements for the longer tenor investment that's needed to support large scale real estate development.
Yeah. Gerhard, I know you have a view on this.
Yeah, sorry, I've got some connectivity issues as well, but I wanted to just make a point that I think probably one of the most important outcomes post-COVID is the realization of asset managers, and also, and with that I include sort of managers of large pension funds, to understand that diversification in their investments is also very important, and that just investing in government bonds is not going to go a long way to help the economy grow, and creating some very interesting, or creating incentives for creating some interesting asset classes like residential mortgage books, REITs, etc., etc. So I think it is very, very important that pools of liquidity start thinking differently around how different financial assets can be structured to allow for specifically a better home loans market in many countries in Africa.
Yes. I sometimes wish all the DFIs would club together and put all their money into a kind of African Freddie Mac or Fannie Mae type venture, just to get the mortgage market going,
or at least sponsor the equity slug of that capital structure. I think there's enough liquidity to locally to support these structures, but I think because it's so new, somebody's going to need to either put a guarantee in there or to put a decent amount of equity into those structures.
Yeah.
If I can say one thing that I wonder about, there's no way to predict this, because right now we don't see any signs of lessening of DFC interest in putting money into markets and helping with COVID recovery. But I wonder also, medium term, even the most developed countries are going to be focused on their own economic recovery. And I wonder at what point there's going to be some pushback on deploying too much of that needed capital outside of the country, and just the general population asking that we focus more on our own issues. So that to me would also be a very strong impetus for accelerating this, local market, local investor participation. And I think there are ways that we could do it with like liquidity, some kind of a liquidity facility, so that takes away one of the objections that pensions fund have, that we can't invest in these instruments because there's no exit. And so, or there's no track record, there's no data to measure the risk, that sort of thing. And I think that may be something that we could all get together and figure out how to help with.
Yeah. Okay, let's turn to some audience questions for the last few minutes, or some more. I've been picking up some of these as we've gone through. Question for Gerhard: what is Nedbank's broader strategy on repositioning its property portfolio, and what are you doing in regard to changing capital structure? What type of reconfiguration would you propose going forward?
I don't think we've got a specific strategy to say we need to change the way we're doing business. What Nedbank has done in the last few months has been very proactive with clients to try and see how we can support clients as a result of where they find themselves from a COVID perspective. And that's very important. The issues must be COVID driven, because I think we all realize that there's life after COVID. So whatever structures we've put in place, or restructuring that we've done, has been on the back of understanding the short-term impact of COVID on our clients. And we've done a lot of work on that in South Africa. and also a little bit in countries on the rest of the continent. I think in terms of ideal capital structure, it very much depends on mainly, I think, where the project finds itself in terms of its life cycle. So I do think that there's a large argument to be built around funding developments with larger slugs of equity rather than debt. Although debt's a lot cheaper, equity creates a lot more flexibility. And then to structure the capital structure only post completion with a higher level of leverage. Obviously, that has got implications for fund structures or REITs in terms of how many projects they can embark on at once, because obviously they can't leverage their equity as much as they would like to. And then, of course, I think the interesting thing about REIT structures is that they require far lower levels of debt finance. And with that, the debt typically tends to be a lot cheaper and tends to be a lot more flexible because there's a lot of equity in those structures. So, yes, I think there's no sort of silver bullet to say that the capital structure must now look like this. But I do believe we need to build capital structure that is more project specific.
Yeah. John, are you taking a similar view on that?
Very, very much so, actually. I think probably Gerhard has covered the areas that I would very much like to speak about.
Right. Okay. Has anybody got another question here? Anybody got the appetite for financing a tenant purchase schemes as opposed to financing affordable housing? I suppose this is the same point as, is it best to invest in the physical greenfield development or in the financial structure which allows that to be viable? Is anybody, any of you guys working on a tenant purchase scheme at the moment? Gozi, I know this is something that CDC's considered in the past. Is this on your agenda?
Sorry, I was on mute. So this would fit within consumer finance and within a debt suite of products. So I think that's more a debt question, and CDC is definitely thinking about the range of options that are possible in that space.
Yeah, we are too. Well, we've already financed in Latin America one lease-to-own type program. We have another one in Iraq, and I've been talking to a number of people in Africa about doing similar types of programs there. It's essentially a backstop for a lack of any kind of developed mortgage financing program. The real challenge is that most of the time it's a development and lease-to-own program. So finding an investor that is prepared to take the development risk as well as the long-term, lease-to-own portfolio risk. It's basically like financing multifamily in many cases. It has its own areas of concern, but definitely something that we can do and have been talking about doing.
Yeah. Okay. Here's an interesting one for you. What has changed about your operations, and how are you managing practical issues to do with monitoring investments when you're thousands of miles away in the middle of the crisis? And what I was saying the other day, that one thing I've noticed in Fusion is that everybody's grown a beard. Basically, we had a management team meeting the other day, and I realized that every male participant had grown a beard like mine. What's changed in your organizations as a result of this crisis, and do you think those changes are going to be long term, or will it be back to business as usual afterwards? Gerhard, would you like to start us off? Any changes in the way you operate?
Yes, so obviously in terms of the assets that we already finance, it's obviously very difficult to get to them where they are somewhere in a country and we can't travel there. We have been quite strict on ourselves that we would not consider any new developments or finance new developments where it's not possible for us to go and monitor the progress on the development and how the development proceeds, because that for us is part and parcel of our risk management processes. So we also don't view that as the end of the world, because a lot of the projects clients are putting in equity first, and then we all obviously are only financing the debt towards the later in the project. And then for the same reason, any new assets that we haven't seen, we would prefer not to proceed to finance them. We think it's very, very important when you look at real estate financing to go and see an asset, understand how the asset operates, understand the node where the asset is located.
Yeah, so basically you're closed for new business. Is that a short way of saying that?
No, because we obviously have seen quite a lot of assets that we haven't financed before.
Right.
So, I mean, in traveling over the last couple of years, we didn't really, or we did not only visit assets that we financed. We visited different nodes. We looked at different assets, whether those were already financed or in the process of being constructed. So we've got a number of assets that we can look at, although we haven't been able to travel in the last while.
Yeah. Gozi, how are you guys coping? You know, I know it is. You know, in London, you can't fly anywhere anyway, and even if you could, when you got back, you'd have to have 2 weeks of quarantine.
Yeah.
How are you coping with that in practical terms?
So in practical terms, we've already begun. Prior to COVID, we had begun a push into the regions that we invest in. We've got offices in Lagos, Nairobi, and Johannesburg, with people also in countries like Zimbabwe and Ethiopia. So we have been rolling out a number of offices, and there are quite a few boots on the ground. But separate from that, I mean, there's a response more generally has been to think about preserve, strengthen, and rebuild. Preserve in terms of supporting our partners, the partners we've backed already, the companies we've invested in, potentially providing more capital as needed to safeguard impact, help them through the crisis. Thinking about strengthen, how do we think about new products or new investments that can help scale up our response to the crisis? And then finally, longer term, how do we demonstrate that we can be a long-term partner to these countries? And so, you know, we are open for business. That's the key thing. And so it's thinking thoughtfully around how we conduct due diligence with our people on the ground, but also employing remote DD where necessary, and just trying to maintain the same level of rigor in our analysis of proposals. So I know it's heavy on the high level and light on the detail, but we are taking it quite seriously. Yeah.
Yeah. Deborah, what about Deborah? You're probably the furthest away from sub-Saharan Africa of any of us. How are you dealing with the situation?
Yeah, very similar to what Gozi said. We're doing virtual due diligence, and with real estate, it's harder. With financial services, it's much more straightforward, really. But with real estate, as Gerhard said, it's very much a hands-on business, and you need to physically be there. We do have some people that we just hired that are located on the continent, a managing director that's in Johannesburg, and then a few short-term contractors that will be distributed around East and West Africa. So we'll be utilizing those resources to give us the eyes-on physical connections. Our due diligence with local engineering firms, for example, our local council. So we're going to try to utilize our local resources as much as possible. But at some point, there will be some projects that maybe we can get them credit approved. Maybe we can get a commitment, but that commitment is going to be subject to a site visit at some point in the future. So we can get them to a point, but we probably won't be able to close them. And that's very much a case-by-case decision.
What about existing projects that you're already in? How are you, you know, and often there's a series of drawdowns. there may be delays and problems because of the crisis or for other reasons. How normally you would go and see these things and find out what's happening on the ground, wouldn't you? And how are you coping with that sort of thing? I mean, are you continuing to finance projects where you're already committed? And how are you managing that?
Yeah, very much, also very much case by case. I would say that all the things that were mentioned earlier, allowing reserves to be accessed, payment moratoria, capitalization of interest payments or rescheduling of principal payments. A lot of projects that are under construction in most countries, they've been delayed because they have to stop work on the site. So the main issue is just liquidity to cover operating overhead for say a 3 to 6 month delay. We have started to see in some cases workers back on the site. So we have started to see some in Namibia, for example, some restarting of some construction work. In almost all cases, the completion schedules, the construction timelines have been drawn out, rescheduled. So our expected disbursement requirements, they've been pushed out. Those timelines have been pushed out. I would say, though, in general, the thinking is that we don't want to just stop these projects. That doesn't help anyone. So we want to try to continue to fund so long as it makes reasonable sense and so long as the client can come to us with a revised plan on how they see the project changing or the timeline or the funding needs changing, and then we'll work with them to continue to fund in order to keep things moving. As we know that with real estate, the worst thing you can do is have a project sit there doing nothing for long periods of time.
Yeah, I think I'll just add that if you think about some of the major cities in Africa that have been in different lockdown scenarios, I think that has helped in terms of the pause and think for fund managers, for developers. And so over the next quarter or two, we'll start to see how they react and how the strategy changes, how the projects evolve, perhaps to be a bit more resilient in current markets.
Yeah.
Yeah, and if I may add, I think for us, basically, we are open for business. I mean, that's the first thing that we need to say. Secondly, we have projects in our pipeline at different stages of the life cycle. So whilst we're looking at projects we've just been introduced to, taking it now through, for example, the first stage, which is an appetite sensing. Other projects are going through the final credit review, whilst others are towards financial close, where we will basically be looking at putting the money on the table for the client in the event that he doesn't put his own project on hold. But like Gosi said earlier, we have a devolved office structure based on a coverage model with regional offices. So most of these offices are fairly close to the clients. And I think it begs the question, I mean, how do we, DFIs, how do we collaborate in the future? You have DFC, you've got CDC in different parts of the world. And then you have us regional players on the ground, closer to the client. Does that not present an opportunity for us to collaborate by making sure that at the end of the day, you've always got somebody who's sitting close to the client who will represent your interests?
Yeah, amen. I think that's a great note to end on, or almost end on, is that, you know, it would be nice to see more of that kind of collaboration. You know, as we come out of this crisis, pulling together to make things work in a pragmatic sort of way. So I'm just we've gone over our allotted time actually, and we're just going to close by, I just want each of you to tell us something encouraging, tell us something that'll cheer us up, and in these difficult times. Deborah, let's start with you. Tell us something cheery.
Oh my gosh, something cheery. Well, on the collaboration front, I will say that I was just talking with a gentleman yesterday who is a funder for CAF and the African Union for Housing. He's involved with African Union for Housing Finance. And one of the things we talked about was just this issue is how can we convene a group of two groups. One is the DFI group and one is the investor group that is interested in the housing sector. And let's talk about how do we move housing, how do we accelerate housing out of this crisis in an effective way and work together to do that. So I actually do think that a working group of the DFIs focused on the housing sector in particular is probably going to happen in a reasonable future.
Great. That would be great. Gozi.
Yeah, I was struggling for a bit, but which isn't helpful. But I think two things I'd say is one is about the future. I think the fundamentals of the sector remain strong. I mean, it's nuanced across different cities and different countries, but broadly the fundamentals are strong. The demographics are still compelling. CDC has been investing in real estate since the 50s. And this will not last. We will come out of this. That's if that's any consolation. And then the second thing on funding, I think we think about government revenues as the primary source of FX in many of our markets, and it's not really. I think the diaspora remittances continues to grow, and when as a sector we are able to tap into that for real estate, I think we'll start to see some interesting results. And also, I think the pension funds, as they grow and grow, again, that opens a whole new avenue for either for greenfield or secondary transactions in real estate. So broadly, I am optimistic, cautiously optimistic, and my level of optimism varies across cities and countries, but I do think the fundamentals are still strong.
Yeah, good. Thank you. Thank you, John. John.
I'm also very optimistic, actually, about the future because we continue to work on a number of key projects. We haven't seen a slowdown in the level of activity. The only thing that we've not been doing really is traveling and visiting clients. But we are talking practically every day to our clients. We are coming up with schemes in Ethiopia, and particularly we are coming in with schemes to support. As you know, the government had invested in what they call them industrial parks, where international businesses were encouraged to set up their factories, and in particular focusing on the garments and apparels industry. So this is one area where we are coming up with a special scheme to help them meet their relatively long-term target. I think a 5-year target of $1 billion in exports. That's an area that we have got really get stuck in the last 3 or 4 weeks.
Yeah, great. Gerhard.
It's hard, but I think the real estate market in Africa is still to a large extent underdeveloped. I think coming out of COVID, we all have the opportunity to, with hindsight, rethink how the real estate landscape should look, and between all the different stakeholders work towards something that looks completely different from what we thought things would look like 6 months ago. Whereas I think lots of other countries have assets that have been developed over years and that look a certain way. So I think that's a very good opportunity for Africa.
Yeah, absolutely. And for my part, I would say, Africa, the parts of Africa that I know are full of resourceful, intelligent people, and they're tough. They're not used to, they don't expect things to be easy or to be straightforward, and they work things out. And so, yeah, I too feel, we'll come through this. There's going to be a few tears. There's going to be a few disasters, but we'll come through it and we'll thrive beyond the end of the crisis. Okay, I'd like to sincerely thank all our panelists for a really interesting discussion. And thank you, all of you, for joining us and for sending me your questions.
Great. Thank you, Phil, and thank you once again to the panelists. This brings us both to the end of this session, but also of our webinar series, which we've been holding since the end of March. So I'd also like to take this time to just thank our moderators and panelists for their contributions throughout the series, as well as the audience for their participation and engagement. We were lucky enough to host over 4,500 attendees across the series, which just shows the interest in African real estate and the need for the discussion to carry on. I'd also like to give a big thank you to our headline sponsor, Standard Bank, and our series sponsor, Nedbank, for their continued support and for allowing us to make this series possible. For the audience and for all stakeholders, we'll be sending out a summary of the poll results, video recordings, as well as the key takeaways from the series in the coming week. We'll also be releasing a COVID-19 impact on African real estate survey with contributions from key stakeholders across the continent. This will be shared with all attendees and it will include insights from different countries as well as across sectors. Finally, we'll also be sending an update on our events, webinars, and trainings for 2020 in the coming weeks. So if anyone wants to participate, sponsor, partner, please feel free to reach out. We will be continuing the discussions across multiple platforms, and we look forward to keeping the discussion going and to coming out stronger as an industry. So thank you once again to the panelists, and we'll be in touch soon. Thank you.
Okay.
Thank you.